This is our Forex blog for January 31st, 2012. And like most days, we want to buy the strongest currencies versus the weakest, and we want to sell the weakest versus the strong. You can see that the dollar is one of the weakest, and underneath the real-time strength or weakness, we have the daily, weekly, monthly, which are blood red. It's one of the weakest. The second weakest is the euro. Strongest is the New Zealand, and probably second strongest is the Australian. So basically, you want to buy the Australian and New Zealand against the dollar if it's showing signs of weakness today. For instance, earlier today it looked like it had some strength, and then it had some intense weakness followed by very little strength. Because the longer term trend is down, that weakness is likely to continue, which it did, only for about 30 minutes, 5 minutes of strength, another half an hour of mild weakness, and then some strength. You never know how long the weakness will come back, but most of the time the weakness will come back and you can look for trades, especially when you see something like this. The New Zealand's off the charts, the strongest one. So after 3 o'clock, it makes sense to look for continuations in that strong New Zealand dollar going up. So first of all, our upper containment bands usually is the limit of where, it's very risky to buy it significantly above the upper 2.0 band. But at 3 o'clock right here, you saw it shoot out, bust over the previous month's high, and this is a pretty low risk trade. It's the strongest currency. You can see incredible strength last night, followed by almost no weakness. And you get long with about a 6 to 12 pip stop max. And here's your first profit target, and here's your second. With this kind of momentum, it's pretty high probability likely to hit the second profit target at 89. You're going to buy the breakout right here at 63. So it's got a 35, 36 pip potential profit, and you're risking no more than 10 pips. That's a good trade. And, once you see it later in the day fail to go and stay above this high, because it's up statistically too much, it's a pretty safe counter trend trade, and you can usually pick up 10 to 35 pips. One of the best ways of doing a counter trend is when you see a double top like this, and this is actually a slightly higher high, but that's even better because it tricks traders into being optimistic about a further upside advancement. And when it comes back down and goes underneath these bars low right here, you go short with your stop right above the high. Again, you're risking just 10 pips plus 1 or 2 pips padding above the high, and you wait for any kind of counter trend signal or for the weakness, as you can see right here and here, to subside. Look at that. The statistical weakness isn't that much. It was very strong before, and you're out somewhere around 65 here for a nice 25 pip counter trend. So you made almost 30 pips earlier, then 25 pips on the counter trend, 55 pips on 2 trades. Now the euro also was extremely weak. You could also have traded the Australian and the New Zealand against the euro. You want to sell the weak euro versus a strong New Zealand. And as you can see, the New Zealand was extremely strong right here at 3. It came down again and went sideways. This is a good place to go short with your fib target. Good place to get out. You're going to get in this trade somewhere around 80 or 48 and out at 14. That's a beautiful 30 plus pip profit. And one of our entry methods, we have really about 2. We find the strongest currencies to buy and the weakest ones to sell. And one of the entry methods is a pullback trade like that. You'd be short with your stop right above the high. It came down a little bit, went against you, came down. Really, it's just going sideways right here. You want to keep your stop right above the high, and eventually it broke. Myself, I don't like to be in trades more than 30 minutes or an hour going sideways. I'd rather just get out of the trade with a 5-6 pip loss, and then when it breaks underneath the lows, go short again. Now you have Fibonacci profit target of this, and you're looking to get out somewhere between the first and second fib target. Using range bar charts it's better for getting out of trades. And let me just briefly show how to know how many pips per bar to put on a range bar chart. We have created a tool that lets you do this. Add this tool on here. And if you want to find a range bar, which is a certain number of pips per bar, instead of 5 minutes per bar, it's X number of pips per bar. You can see the average and median somewhere between 5 and 6 pips per bar. So I'm going to use 5 pips per bar in this case. And let's change the number of days data to 2 because we were downloading tick data to do this. And I'm going to put in 5R. By using this, you can basically move your stop down above the previous bar's high or 2 bars back high. It's going to download the tick data right now, hopefully, if I still have an e-signal connection, which I do. All right, and so during this fall, let's scroll back and make sure I found the right one. Yeah, so it went sideways. It came down to the fib target down there, and let's redraw this on here. And you can see it pretty much stalled right at the fib target. I probably would have got out of this trade right here just based on this chart, but if you were going to hang with it, you can very simply draw your kind of like, or visualize a trend line going over those bars high, and when it goes above those bars, you would exit somewhere around 54885 or 5845. Another way of doing it is simply when it comes down and kind of goes sideways, you move your stop over the bars high right here. It makes a lower low, and this is a new high, and then it comes down and it goes sideways. Really, for about 3 bars, you can always move your stop down. And on a range bar chart, you can oftentimes see fib areas that, oops, I didn't draw this correctly here. Let's bring this down a little bit right there. It's very close to the low right there. In fact, you might even draw it right there. Came within 2 pips of that. So that's a good way of using the range chart. Now the euro was extremely weak. The pound was showing some strength today, but the longer term trend is against that. But you can always, let's go back to 5-minute chart, you can always sell the weak euro against a strong pound. And you can see that this one also, once a currency is making a series of lower lows and lower highs, it's pretty obvious that it's going to go one direction. This is another good example of a sideways rectangle pattern, which is one of the 2 primary methods we get into trades. And you also have the fib target of that down there. And most of the time they don't go below the 1.618. Some traders might draw their fibs on the highest high and the lowest low right here. A lot of times, in some instances, there's no perfect place to draw fibs. You can see that's the fib area that most traders are using because it stopped on the dime at the 1.618 area. So you never know what fib areas traders are going to do, but the longer and the bigger the fib swing, the more likely the 1.618 is to be the maximum low. And you can see it touched it, maybe it went a pip underneath it, and that was the end of the move.